Hey everyone, welcome back to MarketSnap. NBIS just took a massive hit on a multi-billion-dollar convertible note offering, and social media is absolutely flooded with fear. Before anyone panic sells or blindly buys the dip, we're running Nebius through our full analysis engine to see where the numbers actually land. Discount or trap? Let's dig in. So here's the setup. Nebius Group, ticker NBIS, is one of the most explosive names in the AI infrastructure space. We're talking about a company that just grew revenue over 450% year over year. But the stock recently dropped double digits on news of a massive convertible note offering that's triggering dilution concerns. The stock is down 9% over the past week, but it's still up over 100% over the past 6 months and a staggering 200% over the past year. This is a stock that moves fast, and you need to understand what you own before you touch it. Let's step back and talk about what Nebius actually is. This isn't your typical software company. Nebius Group is a technology company built specifically to serve the global artificial intelligence industry. They're headquartered in Amsterdam, with R&D facilities spread across Europe, North America, and Israel. The company is led by Arkady Voloshin, and they're focused on building the comprehensive infrastructure that AI companies desperately need. Think of them as a neocloud. They provide the heavy-duty compute, the data centers, the GPU clusters that AI models require to train and run. With only about 1,500 employees, this is a lean, focused operation attacking a massive market. Now let's talk about the growth, because that's the headline here. Nebius just reported second quarter revenue of over $580 million. That's a 454% jump year over year. To put that in perspective, their full year 2025 revenue was around $530 million. They essentially did more in a single quarter than they did in all of last year, and the trajectory is accelerating. In Q1 of 2026, they grew revenue 684% year over year. The demand for AI compute is insatiable, and Nebius is right in the middle of that bottleneck. The key here is they're not just growing, they're growing with customer-funded expansion. They're securing long-term contracts with substantial upfront payments, which means their customers are essentially helping finance the build-out. That's a powerful dynamic. Now let's get into the earnings picture, because this is where it gets interesting. The company just reported Q2 revenue of $582.3 million, crushing expectations. Gross profit margin is sitting around 59%, which is solid for an infrastructure-heavy business. But here's the thing. Nebius is still not consistently profitable. They reported a small net income for fiscal year 2025, about $100 million, but that flipped to a loss in 2026 estimates. The market is pricing in a massive swing to profitability as the capacity comes online. What's really encouraging is the payback metrics. The company's economics are improving, with customer prepayments now covering 50 to 60% of contract costs. That's a huge de-risking mechanism. They also generated over $2 billion in operating cash flow, which gives them a serious runway to fund their expansion. Looking at the latest earnings call from Q1 2026, management was crystal clear about the opportunity. They're seeing unprecedented demand for AI infrastructure, and they're positioning Nebius as a critical player in that ecosystem. The tone was confident, focused on execution and scaling. They're leveraging strategic partnerships, acquisitions, and multiple financing options to support what is clearly an ambitious expansion plan. Management knows they have a window here, and they're moving aggressively to capture it. Let's pull up the balance sheet, because this is where the risk lives. Nebius has about $3.7 billion in cash on hand and total assets of over $12 billion. The current ratio is above 4, meaning they have plenty of short-term liquidity. But the debt load is growing. Total liabilities are sitting around $7.8 billion, which includes the recent convertible notes. The debt-to-equity ratio is approaching 1, which is manageable for a hypergrowth company, but worth monitoring. The bigger issue is capital expenditure. They spent over $4 billion on property, plant, and equipment in 2025, and that number is only going up. Free cash flow is deeply negative, which is expected at this stage, but it means they're dependent on external funding to sustain the build-out. That's why the convertible note offering matters. It's about funding the next phase of growth, but it comes with dilution costs. Let's break down the SWOT. Strengths. Nebius has explosive revenue growth, a first-mover position in the neocloud space, and an asset-light model that's driving margin expansion. They have strong customer prepayments that de-risk the build-out. Weaknesses. They're still unprofitable on a consistent basis. They have heavy capital requirements, and the capital structure is getting more complex with each financing round. Opportunities. The AI infrastructure shortage is real and persistent. They can expand capacity, sign more long-term contracts, and potentially become a dominant player in European AI compute. Threats. The competitive landscape is brutal. You have hyperscalers like Microsoft and Amazon, plus other neoclouds like CoreWeave, all fighting for the same GPU supply and customers. And there's the dilution overhang from the convertible notes that just spooked the market. Looking at the price action, this stock has been on an absolute tear, up over 900% over 5 years. It pulled back recently after the convertible note announcement, dropping about 10 to 13% in a single day. But the longer-term trend is clearly intact. The stock is up over 100% in the past 6 months and over 200% in the past year. The volatility is extreme, though. This is a stock that can move 10% in a day in either direction. If you're looking to trade around the short-term move, you need to respect that this is a high beta name. Beta is around 1.4, and position sizing matters enormously. Now let's get to the core question. What is this thing actually worth? We ran Nebius through our valuation engine, and given the hypergrowth profile, we used a forward PE model with high confidence. The DCF approach isn't reliable here because the company has negative free cash flow while it's in this massive capex phase. The forward PE model is better suited because we have solid analyst estimates for the earnings path ahead. We applied a terminal multiple of 28 times forward earnings, adjusted for execution risk and the capital intensity of the business. That's a reasonable multiple for a company growing at this clip, though it leaves no room for error. So where does that land us? Our model puts fair value for NBIS somewhere around $400. The stock is currently trading around $280, which means our model suggests there's maybe 40% upside from here. But here's the thing. This is a rough estimate, not a precise target. The fair value swings dramatically based on your assumptions. If you use a more conservative growth rate or a higher discount rate, that number drops significantly. If you believe the hypergrowth continues, it could be worth more. The model assumes roughly 7% annualized returns over the next 5 years if the stock converges to fair value. And if you put $10,000 in today, the model suggests it could be worth around $14,000 in 5 years. But you can run your own valuation on our intrinsic value calculator at MarketSnap.com and see how the number shifts with your own assumptions. The point is, the market is pricing in a lot of success already, and the margin of safety depends entirely on how confident you are in the execution. Here's my honest take. Nebius is a phenomenal business in the right place at the right time. The AI infrastructure shortage is real, and this company is one of the few pure-play ways to invest in it. The growth is staggering, the customer-funded model is smart, and they're executing well. But I have real concerns about the valuation and the capital structure. The stock is trading at a massive multiple of sales, north of 60 times, and the recent convertible note offering is a reminder that this company needs constant external funding to sustain its growth. That dilution pressure is going to keep weighing on the stock. I think the risk-reward here is balanced, maybe slightly tilted to the upside if they execute flawlessly. But you need to have a strong stomach for volatility. This is not a set-it-and-forget-it stock. What do you think about NBIS? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. all in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our Stock's Intrinsic Value Calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.